good.
Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines at this hour. Global auto major Ford is set to slash over 7,000 jobs as part of its business restructuring process. The exercise is likely to be completed by the end of August. IRDAI proposes increasing third-party insurance premium for cars and two-wheelers, seeks comments from the stakeholders by the 29th of May. Sticking to autos, Tata Motors profit halved in the fourth quarter but surpassed analyst estimates. Muted sales in India added to the slowdown faced by JLR. And higher inventory gains boosted refiners' earnings. BPCL's profits surged over six-fold to the highest in almost 2 years. HPCL too saw its profit jump 12-fold. Let's have a look at the trade setup for the day. It's difficult to really make a case for what will happen on the day today after what's been the best day in the decade. But we'll get to that in a bit. Firstly, the global setup. And the trade war sparks continue to fly. China has said in unequivocal terms that it's vowed really to retaliate to US bullying. That's actually the top story on the network as well, Bloomberg Global. And companies in the US have written to Donald Trump talking about how the imposition of tariffs is catastrophic. So the pain is being felt by almost everybody across that value chain. The question mark only is whether this is positive for India or no. We'll get to that. However, despite this imposition of tariffs, remember, and one would think that since this has happened, the markets have corrected quite a bit. The global markets, which is the S&P 500 or the MSCI Asia Pacific, is still in the green for the year, despite post-tariffs. The markets having come off. That's the chart. And the marking, the red marking, is at the time when Donald Trump imposed the tariffs. Post that, there has been a bit of a correction, but it's still above the negative return mark, and more so for the S&P 500. So mind you, if this war continues, there's no saying how much lower can the world markets drift down towards. And because of all of those commentary, the world markets have been a slightly tepid place. So US markets ended in the red last night. Asia is a mixed bag right now. Nikkei is down about 0.5%. Hang Seng about 0.25%. The SGX Nifty, well, and we have reasons of our own to do what we are doing, but is showing a sign of starting off on a flat note. And that wouldn't surprise most people, because after such a big bang day, you have a start which is usually a bit more sedate, and then as the day builds up, if the momentum is to continue, you see some buying coming in. So post the best day in a decade on Monday, we might have a sedate start, which is very, very likely. The only question is that after multiple days of negative outflows, FIs put in money in trade yesterday. Will that continue? That's the question they're going to ask yourself, because in all probability, the flows that have started coming in yesterday will not really take a step back immediately in one day. So you probably presume that those flows might continue, and therefore what is very important to monitor during the course of the day is the kind of movement that the FI dominated stocks do. So in yesterday's session, you had the Reliance, HDFCs, even in the mid-cap space, stocks like Just Dial, etc. do well. Those are the pockets that you need to monitor, because it is now the FI flows which will have a bearing on what the markets do from here on, at least till Thursday. And once the clarity comes in on Thursday, we'll probably figure out what the DIs do. Speaking of the flows, remember, the reason why I put this out is also because FIs were net buyers yesterday. DIs sold about 542 crores worth of shares. So it's a very interesting positioning that happened between the FIs and DIs in trade yesterday. But I must admit, it's very, very difficult to predict what the markets could do on a daily basis, more so after such a big bang move that has happened. The only thing that you can take heart from is that with the backing that the exit polls have, until the May 23rd, we are unlikely to see a big crackdown unless there is some major profit booking that happens due to nervousness. But otherwise, big gashes might be difficult to preempt. Having said that, what we can talk about are stocks that are likely to react in the session today. So 3 or 4 names that I thought were important and should bring to you. United Breweries, the Q4 earnings disappointed in a big way. EBITDA margins were down to 10.5% from 14.1%. Higher employee costs and other expenses impacted EBITDA meaningfully. Let's wait and watch what happens to the stock. Wouldn't be surprised, even in a green day, United Breweries were to react negatively. A couple of footnotes in the notes to accounts as well, which could be important monitorable. So watch out for these. stocks. Watch out for Torrent Pharma, the net loss number due to a write-off of 30 million from the biopharma acquisition, which has led to the loss. The growth in India business, however, below estimates. And even though the margins expanded for Torrent Pharma, the overall numbers were below estimates. The margins too were below estimates. So keep that at the back of your mind. Optically, the numbers and the margins may look okay, but the numbers were below estimates. Let's wait and watch what happens to Torrent Pharma in the session today. Dhampur Sugar. Now, this shouldn't surprise anybody that the sugar companies are posting good numbers, but just look at the numbers. EBITDA up 15 times at 180 crores versus 11.9 crores. Margins at 20.3% versus 1.3%. And I repeat, again, while optically the numbers look really robust, they're marginally below what a few people were working with. Having said that, it's a very good set of numbers. Wouldn't be surprised if the stock has a further enhanced reaction on the upside. 215 was up 7.5% yesterday. Let's wait and watch what happens today. And I thought PI Industries was important to monitor because that's a stock that's hitting fresh highs almost every single day. In yesterday's session too, closed at fresh life highs. And CT's come out with a note and hiked the target price to about 1303 from 1061. Let's see if PI Industries does more in store. A bunch of other stocks, and we'll talk about all of them in the course of First Word as well as the show ahead. Speaking of First Word, let's tell you what's lined up on that piece. Tata Motors and JLR seem confident that the worst is behind, but analysts aren't convinced just yet. Yatin tells us why. United Breweries missed estimates in the fourth quarter. Agam tells us why the brewer can't blame beer drinkers for the miss. Summits found companies where the earnings have left room on the upside. And as the Modi government completes 5 years in power, Yash compares the market cycles over the past 4 governments. Let's first start off with Tata Motors. Profit nearly halved in the fourth quarter as the domestic sales slowdown added to the hurdles faced by JLR. Yatin Mota is with us to take a closer look at the numbers and what brokerages are making of them. Yatin, good morning. You spoke to the management as well. Tell us what stood out, but firstly, the numbers analysis.
Neeraj, if you look at the results broadly in line, there were no surprises. As expected, they had a 6-7% decline in the consolidated revenues. If you look at the JLR margin also, they came in broadly in line. We were expecting a JLR margin number of 9.5%, and that is the most important number that you watch out for. And they delivered a JLR margin number at close to 9.8% versus the consensus of 9.5%. More importantly, the management commentary matters because it was the last quarter in which the results were announced, and now we enter into FY20 in terms of strategy and plan guidance by the management. The most important market, the most profitable market for China is something that the management discussed with us in depth and also with the analysts. More importantly, they do believe that from here on, the China profitability would improve. Last time they had posted a negative EBIT margin. This time they're expecting that not only the turnaround will happen, but more importantly that dealerships are also returning to profitability. Also, they have cut down on the overall working capital requirement for JLR in China, and because of that, they are hopeful that with the new launches coming in, the free cash flows would improve. In fact, they were talking about Evoque, which is a big product in China, and how that will aid the overall volumes as far as the China market is concerned. Now, talking about the second important market, which is US and UK. Of course, there have been challenges there, but despite all of that, they are gaining market share both in US and UK. They are doing better volumes than the peer set at a lower discount, which means that the realizations for the US market are improving significantly. However, the key headwind here is Brexit as well as trade war. These are the two hangovers probably which Tata Motors is looking at this point in time. More importantly, as far as the US market is concerned, that remains healthy, but a Brexit could impact the first quarter earnings according to the management, because they are expecting or anticipating that there could be a chance of a hard Brexit. As far as India market is concerned, again the management was sounding confident. Of course, the first half will remain muted like other auto companies, but if you look at the overall India strategy, they believe that they are not phasing out any diesel cars, something like what Maruti did. They are confident that volumes will come back into the marketplace once there is a normal monsoon, and probably post the election the demand will get bottlenecked to a certain extent. And finally, as far as BS6 is concerned, they are expecting that the pre-buying will aid the overall commercial vehicle business. Guidance, this is something important that we discussed in the yesterday's press conference and interviews. The guidance is maintained at EBIT of 4 to 6% for FY20. When I asked the management, were they confident of delivering 4 to 6% EBIT margin, given the fact that there is Brexit, trade war, diesel car issue in Europe, a lot of other things, they said that it is possible since a lot of working capital will get reduced. More importantly, their cost-cutting plan in FY20 would deliver significant amount of profitability for them, which makes them believe that 4 to 6% EBIT margin is still achievable as far as FY20 is concerned. Brokerages, they remain negative. CLSA maintains a sell on Tata Motors with a target price of 150. They do believe that JLR outlook remains weak and cyclical pressures are seen as far as India business is concerned. They have cut the FY20 EPS by nearly 18%. Similar is the case with UBS. They maintain a neutral with a target price of 200. They say that JLR margins were above estimates while India was slightly below expectations. And also more importantly, the net debt reduction which happened in the fourth quarter is largely seasonal, and capex cut will help a little as far as free cash flow generation is concerned. So the brokerages remain slightly skeptical. However, the management does believe that there are opportunities in the marketplace, especially for markets like US and China.
Okay, let's wait and watch. Tata Motors, not as big a howler as happened the previous quarter, but the profits have certainly halved. Let's see how the market reacts to these numbers. Yesterday, the stock did very well, but yesterday the markets at large did very well. So let's wait and watch what happens today. Well, one can safely surmise what could happen to United Breweries today, because that's reported an operationally weak quarter, owing to higher costs and lower sales in some regions. Agam Vakil is standing by with the fine print. Agam, good morning. Why is United Breweries so important in the session today?
It is important because this is a surprising hit on the operational margins, and it's a genuinely operational problem because we've seen just a steep rise in all the expenses. So when it comes to your revenue growth, we aren't really looking at too much of a problem, despite the fact that it's been a little bit of a miss. And let me just start off with the numbers, the headline numbers. So net sales have risen by around 11%, and but it's your EBITDA margins which are contracted to 10.3% against 13.5%. Net profits down 25%. Now, the reason why there has been a miss when it comes to its top line is because of West Bengal. There's been a steep duty hike, which is why sales dropped significantly for this particular quarter. But all the other regions, North, West and South, have done reasonably well, and they've been steady for United Breweries. But the big hit comes in operational standards. So your gross margins have come off 220 basis points, essentially because of raw materials costs which have gone up. Your other expenses have gone up as much as 15%, and this is likely to do with the marketing spends for the non-alcoholic part of their business, which they've just recently ventured into. And they've also seen a steep rise in employee benefits, so that's come up as much as now nearly 11.8%. All these factors taking into consideration is the reason why you're seeing that very sharp drop in margins, something that we will be looking forward to when they have the conference calls, as well as something which will emerge in brokerage notes. The earnings came in at 12 in the night, so I reckon that we will start getting reactions and a little more clarity as to why there was such a sharp drop in operating margins.
But nothing that Shekhar Ramamurthy had indicated in the previous few quarters, Agam,
no,
about this.
Certainly not. And this is something that none of the analysts were expecting either. So it certainly is a very sharp drop in operational margins.
Okay. Thanks, Agam, for putting that into perspective. If we can get the analyst recommendation chart, the ANR chart on the Bloomberg Terminal for United Breweries, that will throw some perspective. Mind you, that will change dramatically post these numbers coming out. But aside of that, I mean, if you had to bet on the liquor market in India, there were arguably three companies that you could do that. One is United Breweries, one is United Spirits, and the third is Radico Khaitan. And as you can see out there, there is still some upsides ahead of these numbers that the analyst community was giving, despite the fact that both United Spirits and at least United Breweries on a valuation front is not cheap. However, I dare say this may change very much post this quarter's miss that United Breweries has given. So let's wait and watch what happens to the stock in the session today, because it's an operationally weak quarter and the markets are likely to start off on a flattish note. You wouldn't be surprised if it has a bit of a red start. Well, in the midst of, let's move on, and even in the midst of the record rally in the equity markets and growth concerns in the larger economy, there are some stocks where the prices have not captured the earnings potential. Samit Sarkar is standing by with a list of such stocks that have left some room for growth. Now, Samit, how did we arrive at this study? What are the parameters? And then what are the companies which fit the bill?
Well, the companies that I'm going to mention, we believe that at least they are in a sweet spot, and that is because we have considered the PEG ratio, and these are the top 10 stock that is the cheapest PEG ratio. Now, PEG ratio factors in the P multiple of a stock and also the earnings growth potential. And how have we come to this list? So first, we have selected stocks with have more than 10 analyst rating, obviously excluding the BFSI sector. Along with that, we have considered the 12-month forward price to earnings ratio and the compounded annual growth rate of EPS that is expected over FY19 to 21. Now, all this data has been compiled using the Bloomberg Terminal, and that's how we have derived the PEG ratio, and we have selected the top 10 stocks. Now, among the top 10 stocks, if you see, first on the list is Orient Cement, which has a PEG ratio of around 0.19 times. Now, that is because now its EPS is expected to grow on the back of its higher volume growth, higher prices, company's focus on cost rationalization, and its proposed capacity expansion that is expected to boost its earnings. However, the street has not given it a high valuation because if you see, there has been a consistent delay in the deleveraging plans of the company, and that is because of the continuous capital expenditure that the company has been incurring. Along with that, the company also has a concentrated presence. It is present in only 3 states, and that's the reason the stock has not been given a higher valuation on the street. The second on the list is Apollo Tyres, which has a PEG ratio of which also has a lower PEG ratio. Now, if you see for Apollo Tyres, a double-digit earnings growth is expected on the back of a strong replacement demand. Along with that, a ramp up of its Hungary and Chennai plant are also expected to boost its earnings. However, the street has not given a high valuation to Apollo Tyres also because of the aggressive capacity expansion that the company has been doing amid slowing down of demand. Along with that, its rising debt is also one of the concerns when it comes to Apollo Tyres. Third on the list is Lupin. Now, a recovery in the US market, cost rationalization efforts of the company, monetization of complex generics investment, and ramp up of specialty portfolio is expected to boost its earnings. However, on the negative side, if you see, it's a higher tax rate that the company is expecting for the next 2 years. No certainty of the resolution of US FDA timelines. Along with that, muted growth expected in the Japan market and low probability of a break-even in the specialty businesses is what is weighing down on its valuations so far. Fourth on the list is Vedanta. Now, higher production across all the segments of the company is expected to boost its earnings. Along with that, the steel acquisition that the company has recently done and higher coal availability is expected to boost its power plant. So this is what is expected to aid its earnings growth. However, the US-China trade war and related party transactions have weighed down on its valuation multiples so far. Fifth on the list is Centec Realty. Now, high pre-sales volume. Along with that, completion of 2 key projects, that is in Goregaon and Naigaon. Along with that, steady sales in its BKC projects is is expected to aid the company's earnings growth going forward. However, the tight liquidity situation seen in the current market, along with that high-ticket unsold inventory, concentration in few markets, and no new projects have weighed on the valuation of the company. Now, along with these 5 companies, there are other companies like Shoppers Stop, Granules India, Kalpataru Power, Oberoi Realty, and KEC International, which feature also on the top 10 list. And to know more about them, do log into our website, that is bloombergquint.com, to get in more details on the earnings growth potential and the valuations of these companies.
Okay. Amit, thanks for putting those into perspective. And remember, for the benefit of our viewers who don't quite understand the PEG ratio, it's the P ratio divided by the growth potential of the company. Now, you would have heard Sumit say at the beginning of his piece that the growth numbers that are considered is the CAGR growth numbers from FY19 to FY21, which is the earnings growth. Typically, the price to earnings multiple assigned to a company is a factor of the growth that the company comes in as well. So if the price to earnings multiple is 10 and the company is growing at 10%, the earnings growing at 10%, then the PEG ratio, which is the P multiple of 10 divided by the growth potential of 10%, comes to 1. And that's the basis for this piece, that if you saw one of the slides which Sumit put out for Orient Cement or some of the others, when the PEG ratio was 0.19, which means that the growth numbers are much higher, the denominator is much higher than the numerator, which is the P multiple, and therefore the upside potential could be perceived to be substantially higher. Very interesting piece, Sumit. Thanks so much for bringing us that analysis. And remember, as Sumit said, do log on to our website and click on to that story if you want to know more about those 10 companies which have the best upside potential chance based on the PEG ratio. Keep in mind, we do not consider financials here because the banking and financial stocks are not considered on a P multiple basis. They are considered on a price to book basis. They are valued on a price to book level. The last piece on First Word today is an analysis on Well, numbers. Narendra Modi may continue to reside in the Prime Minister's residence for 5 more years. And while we'll know for sure on Thursday only, the equity market is already celebrating. The euphoria was similar when BJP-led NDA came to power in 2014 with a higher than anticipated lead over the opposition. But have the returns been that phenomenal over the last 5 years? Perhaps not. Yash puts that into perspective. Yash, the numbers.
Morning, Neeraj. So the last 5 years have in fact been phenomenal for the markets. However, if you compare it with the 5-year period of the previous governments, well, in that hindsight, they haven't been all that great, because if you take a look at the 5-year returns over the last 5 years for the Modi government, the Nifty has run up by almost 58% compared to a 78% jump in the Nifty mid-cap index and a 44% increase for the Nifty small-cap index. Compare that over the last 5-year period for the other governments, and you'll see that those numbers may come slightly short of what we have seen previously. But moving forward, let's take a look at which were the top wealth creators in the last 5-year period. And like I mentioned, 58% returns, or in fact more than that, by the Nifty, with 45 of those 50 stocks giving positive returns, with only 5 stocks being in the negative in that 5-year period. Bajaj Twins topped that list, with Bajaj Finance gaining over 1700% in that period, which is in fact more than the gains that we've seen in the last 5 period for any of the mid-cap as well as the small-cap stocks that we talk about later on in the show. Bajaj Finserv not too far behind with an 873% jump up in its returns. Titan, being the play on the consumption side, has seen a big move on the upside, 288%. UPL, it came under troubled waters sometime last year in the month of July ahead of the acquisition of Verista. There were concerns with regards to the high debt that would come in, but since then it has seen a phenomenal run, and it has been hitting fresh lifetime high in every new trading session. Eicher Motors stands out from the auto pack, 230% higher on the back of strong demand that we saw for the auto companies over the last 5-year period, barring the last 10 months that we have seen some amount of slowdown coming in for the auto names. But moving forward, well, we'll take a look at which are the top 5 wealth destroyers, and the counterpart to Eicher Motors is Tata Motors, which is down 60%. The troubles with respect to auto sales slowdown in China and the other European markets, that has weighed down on the counter. ONGC too came under pressure following its bid to acquire the majority stake of government in HPCL. That one's down about 35%. Sun Pharma, with respect to its corporate governance issues with respect to Aditya Medisales, that took a knock of about 33%. And Coal India and Vedanta, they round up the list of the top 5 stocks which have been the largest underperformers in that period.
Okay, and what about the broader markets, Yash?
So even in the broader markets, Neeraj, it has been a great 5-year period. So we'll start first with the mid-cap index, and that has run up almost 78%, with 75 of the Nifty mid-cap 100 stocks giving positive returns in this period. Which are the top wealth creators in that period? Indiabulls Ventures is up 934%. Its foray in consumer finance business being the key turning point for the company. Bombay Burma, which is the holding company and has rich investments in Britannia and Bombay Dyeing Group, that one's up 628%. HEG was the largest wealth creator in the calendar year 2018, following the industry shift to less polluting and more efficient form of steel production using the help of electric arc furnaces, which pushed up graphite electrode prices, and HEG being one of the largest players globally. Sterlite Tech is up more than 566% in this period as well, and SRF from the specialty chemical space rounds up the list of the top 5 wealth creators. But moving on, let's again take a look at which were the top underperformers, and the troubles with respect to the burgeoning debt and the group's inability to service it took a knock on some of the Reliance Group stocks. So Reliance Infra as well as Reliance Capital, they are down anywhere between 92 to 71%, and the list is largely dominated by the other PSU banks, so Bank of India, Union Bank. Aditya Birla Capital has a mention over there, down 70% in the same period. Moving on to the Nifty small cap index, that has had a 44% run in this period, with 71% of those stocks giving a positive return again in this period. The largest wealth creators, they include the likes of Minda Industries, Aegis Logistics, Philips Carbon Black. Minda Industries is a large auto ancillary company which has a significant amount of revenues coming in from Maruti and the other large auto dealers. Aegis Logistics is a fully integrated LPG supply chain company. the post 2014, the government's measures in order to boost LPG consumption, that has been a big positive for the company. Philips Carbon Black, again, it is into specialty chemical, makes a special chemical which is known as carbon black. It was under severe, limitation in the country. It was imported, and later on they expanded their capacity. The government had to come in and put an anti-dumping duty, and later on even hike the anti-dumping duty, which was a positive for the company. Avanti Feeds and Sonata Software from the mid-cap IT space, they make up the list of the other two names for the space. And lastly, the biggest wealth destroyers, this list is completely dominated by the PSU banks, UCO Bank, Syndicate Bank, Andhra Bank and Oriental Bank of Commerce, all down anywhere between 98 to 71%. Suzlon Energy too gets a mention over here, 70% down in the last 5-year period. Back to you.
Oh, thanks a lot for that, Yash. That's interesting analysis, but as they say, at times numbers hide more than they reveal. Amongst the top performers were companies like Sterlite Tech for the 5-year period, but in the last 6 months has been clobbered out of shape from highs of 398 down the way to 165 or 170. So a lot of those stocks have actually not done well in the last 6 months, despite they having done well over the last 5 years. That's all that we have on First Word today. Lots more lined up on Indian Open. We discussed the fourth quarter earnings with Mukesh Kumar Surana of HPCL. That's coming up. Baba Kalyani of Bharat Forge and Hiranand Savlani of Astral Poly. We also talk about today's trade after this very short break. Stay tuned.